First rates on your screen any second now. First rates on your screen any second now. It's a perfect market breadth. I'm not so fixated with the Nifty number today, but it's a market breadth. 1:12. Hello. This is like a near perfect bull market breadth. You see this kind of a market breadth and you say, wow, touch wood. Bulls, where were the bulls? And why are they back so suddenly? The market breadth is near perfect. IndusInd Bank, Infosys, Power Grid, ICICI Bank, some of the stocks which I'm speaking in one breath. You want to look at Jubilant Foodworld. There are 4 reports on my table. All 4 of them are talking about expensive valuations in the near term, and things could get bad before they get better. All the QSR stocks, even though it's fashionable to talk on the India consumption story, for the moment, Jubilant Foodworks is down by about 3%. Sapphire Foods flat. Jubilant Foodworks 18 rupees down. Tata Motors 519, Bajaj Auto holding up. I want to look at TVS because if the subsidy on the two-wheeler is going to go down, that means the smaller incumbent players will also suffer, and a company like TVS and Bajaj will actually benefit. So I will not be surprised that TVS could actually come back in the second half of it.
Yeah, a couple of other names. Jindal Stainless, of course, the India business volumes, the calculated EBITDA, all has done well on a sequential basis. So that's one stock in focus. There's Restaurant Brands as well, which came out with its numbers. The India business revenue, the India same-store sales growth, all have seen a decent uptick. JK Tyre, the margins have expanded about 350 basis points. There's MTAR Technology, Honeywell Automation. In fact, Honeywell has seen an EBITDA jump of 59% and margins are up more than 300 basis points on a year-on-year basis. MTAR though is not reacting to its positive numbers. Honeywell has gapped up 8.25% as we speak. Endurance Technologies, Team Lease, they all came out with a decent set of numbers. So just look out for those as well. There's also REC which came out with its numbers. Not an impressive set. The NIMs have actually been lowest in about 20 quarters. Railtel too, unfortunately, the margins have come in at 14%. The EBITDA though has seen an uptick of about 2%, and remember the margin comparable is 20.7%, so 14% is what they've delivered. Whirlpool as well, not a great set here, margins at 6.3 versus 8.6. Vedant Fashion, that's the important one that I definitely want to bring up because there is an OFS in place. The promoter is looking to sell up to about 7% stake via OFS. The floor price has been set at 1161 rupees per share. 3.25% lower for Vedant Fashions as we speak. Sanghi Industries, GSK Pharma, they've all reported a weak set of numbers, and you can see that reflect on the stock price as well. There's JSW Steel too, which is another stock which is in focus. They've turned out to be the preferred bidder for composite license of an iron ore mine. That stock though has started off well in the green as we speak right now. What about the big buzzers from yesterday? Hero MotoCorp, IndusInd Bank, Exide, and then let's check in on what SBI is doing ahead of its numbers, as is ITC. Those stocks will just come off you next. SBI holding up nearly 0.5% or so, 588, and so is the case with ITC, hovering around that 430 rupee per share mark. For the index as well, it's not a bad start, Kunal, with 18,300 back in sight.
Yeah, it's a good comeback for the index, I would say, from yesterday's selling, which we'd seen, in fact, the last 2 days. So let's hope that the move sustains and it's not a half an hour, 1 hour move for the indices. We'll need to see support from many large cap names in that aspect. Now, the stock which I would look to trade on the open would be L&T Finance. The stock making a strong comeback above the 3-digit mark for the first time, I think, in the last 2 or 3 years from 2020-21 is where the stock has come back above that 100 levels. Looks attractive and would be a stock which I would recommend to clients as well.
Right. Nooresh, what are the first trades that you're punching in?
So it's the same stock, L&T Finance Holding. That's the one which is breaking out on a 2-year high. Expecting it to continue in the whole NBFC space to remain in momentum.
Ajay Srivastav, good morning. How are you doing, sir?
Good morning. Life couldn't have been better, right?
Yes, it's always the spirit which I always admire about you. So what should we talk? What should we start with? The lovely jacket and the inspiration behind this you're wearing? Your golf game and your handicap? Or how much money you've made in last 1 month? I'll give you 3 options.
Okay. Give me the options.
No, I'm actually intrigued with this, with the jacket of yours. Early morning,
this is
40
a brand
degrees,
which I have invested in. Can you believe it? It's a brand which I have invested called Jivo, which strangely you'll find I've invested in a brand, a lifestyle brand. is an Italian brand. So I've invested in that company and therefore proud to wear my own product.
Style of rich and famous, that's what I can say. India में बहुत brands हैं अजय भाई. Lot of good brands in India. How about investing in Indian brand?
You won't find this jacket. You can try it.
Okay. What about markets? What's keeping you busy?
I think markets has been very good because, it's rewarding your patience. It's penalizing your exuberance. The good themes are getting traction. The bad ones are getting revalued. So it's one of those markets where you kind of find pricing to almost perfection, and the euphoria is missing, pessimism is missing. You're being realistic about what you expect in the market, and more importantly, market is giving a lot of opportunities to book profits and put money in the bank. And I think it's a real good combo that you got good sectors like aviation, etc., handsome returns, hotel, handsome return. You got bad sectors which are like QSRs and others. And you got some, interesting plays, which I keep doing, which I keep saying that's the long term, which you keep buying, minerals, metals. They've done a decent job. The profits will fall and rise, but they've been a good kind of mix of companies. So I think it's been a very nice story. No hiccups, no sudden drops, no sudden rises. Can't get better for an equity investor. Believe me, it's one of the golden ages I've seen after a long time.
So then why are you investing in an Italian brand company? Invest in Indian stocks.
That's a good point. I think as we age, we acquire madness, don't we?
You just mentioned and something what Avan, me and Aisha were referring to, that QSR, it's a great play that Indians will eat more, our calorie consumption is going to go higher. We've acquired more global taste in terms of eating a pizza and a pasta. But you said that those are expensive stocks and you are booking your gains there. Why is that?
It's been booked and, it's booked and gone long back. It's not the moment you realize that in an economy, the consumption story is slowing down. The discretionary consumption is slowing down. Whether we like it or not, higher interest rates are going to expand your EMI payout, leaving less money for discretionary. And we've seen very clearly that customers have gravitated towards putting in money in holidays, travel, more than cinemas, more than consumption, more than buying, goods and services at the end of the day. I think QSR story is done for the time being for the two simple reasons. India's consumption story is going to go down this year with the EMIs expanding. That's one. And number two is that as you cut going out, the ability to buy in also less. And third, cloud kitchens. Now, those are killing this brand because I don't know if you have ordered, I'm sure all of you have ordered, Aisha would have ordered. The cloud kitchen options are expanding by the dozens. You get some niche products, you get French, Italian, whatever it is, and very good offerings compared to standard fares of a Domino's or a Pizza Hut. And those are eating into the market share very quietly, steadily. So you really find that today when you go out, nobody orders a pizza from the regular two places. It's always a cloud kitchen, always a niche maker from whom the pizza is ordered if you go out somewhere or the food is ordered. So I think those are waging double whammy. They're not profitable. The scale is suboptimal. And whether we like it or not, at the end of the day, when you come back from abroad, you still want Haldiram Chola Bhatura.
Absolutely. Completely agree with that. Plus, I don't think we are the audience who would be eating, Domino's or Pizza Hut anymore. Nikunj,
Why is
do
that?
you?
Yeah, of course.
You do?
Once in a while.
Okay.
Oh, you don't eat?
Not Domino's.
Which one do you consume?
That doesn't say anything about the stock price. I'm just purely talking about the pizza.
Avan?
Yeah.
Like Ajay was saying, there's so many options
No,
today.
first, you don't
because
need
you're
Domino's
not
pizza.
sticking to your traditional.
You don't eat Domino's pizza, that cheese pizza.
Not that often as one used to, and it was the only option, is what I guess.
Exactly. There's so many options.
Yeah, but
We'll order chalo today.
Jubilant Foodworks has moved, and just to be a devil's advocate in defense of Jubilant Foodworks, they are diversifying. They moved into biryani, they moved into Chinese. For me, Jubilant Foodworks is a company which has the ownership of the supply chain, and can they scale up on that? I mean, Domino's Pizza is one of the businesses they are in. I'm not saying the good stock to buy, but to assume that Jubilant Foodworks is only a pizza company, I think it's being unfair to them.
Yeah, we were just talking about pizza. We were not talking about company or stock.
Well, the question is, what are you buying at? You're growing, not even growing these companies. And the valuation is just crazy what people have bought the stocks and holding on to them. Why would you want to buy a P of 40 and 50 in a company which is almost growing at 0 or 7.5% single digits? It doesn't make sense. And the beauty is, India is getting so many newer stories coming out. See, we just invested in a company which has done remarkably well, which was doing those lounges at airlines. Now, very niche and very profitable. Now that's kind of stock which has done phenomenally well for us. We've seen a watch company which does fancy watches all over the India. So, Nikunj, also we have to gravitate away from, I keep saying, mass consumption driven companies to the companies which are catering to the rich of India, because India's K-shaped economy growth tells us that the rich of India is where the consumption play is going to be. So you see these airport lounge companies doing well. You see the expensive watch companies doing well. You see the airline doing well, expensive hotel doing well, but you will not find mass items doing well. And I think you will find that the mass retail companies are going to see the worst slowdown in April, May, June they've ever seen. And that will come to bear on whether it's Reliance stocks or it is the other retail stocks. Just watch what happens in April, May, June quarter. It's going to be a slowdown which market doesn't even understand happening in the market.
But that similar logic, Ajay, can be applied even to apparels, for instance. Everything from a Trent to ABFRL, Trent in particular, or even the Italian brand that you're invested in and sporting right now, all of them are sitting at rich valuations.
See, no, valuation is not rich. Unfortunately, Aisha, valuation not rich. Look at ABFRL. It has never made money for anybody. For 10, 15 years, it has made no money for anybody, any stock. And for the market position, I'm short on that stock. I'm not saying negatively about it. But the fact is, they never make money. They're the best brands. They never make money. And therefore, one comes to a conclusion that when you cater to the mass market in India, either you follow the Indigo model, which is highly efficient, cost-effective model, or you are going to be, have a problem in the return. When you said Italian, as I keep saying, the expensive part of India is still buying and buying heavily. You saw the kind of prices in Mumbai. If I were to ever work in Mumbai, Nikunj, I wouldn't be able to afford a house in Mumbai. I don't know where I'll stay. Maybe I'll stay in Pune and drive to Mumbai every day. All right. So that rich segment of India, Aisha, is got serious money. It's spending those money today in India. And therefore, I believe anything which focuses on that segment is going to do very well in this year and next year and so on. Anything focused on middle market, below middle market level is going to have troubled times. So, I keep saying, whether we like it or not, it's not fair to the world. It's socially not equitable to say this. The fact is, Indians rich have never had it better than this, and they are spending money and showing it. So when I talk about my investment, I just focused, and you say, talk to the guy who can wear a 15, 20,000 rupee jacket. I think they're abundant of them. You want a guy who wears a 4,000 rupee jacket, you're going to find a problem finding enough of them.
So apart from investing in high-end Italian menswear and fashion wear companies, where else are you investing?
See, I think we have reasonably invested in aggressive customer stories catering to the Cape market economy, as I mentioned to you, whether it's the airline lounge company, whether it's expensive watch company, whether it's airlines, whether it's hotels. I think India's story to us is restricted to that bit. And the large bit is the industrial companies. I think good or bad outcomes can be whatever it is. The capex plan of the government is giving major boost to all these companies. And if you've seen history over the 7-8 companies in the sector, doing wonderfully well, deleverage, good order book. So industrial capital goods is the second largest block of our investment at this point of time after this discretionary luxury products.
Well, speaking of, that segment as a whole, Ajay, I bet if you're looking for a booking for the summer, you're spending a hell of a lot of money to get in these hotel bookings, etc., because prices have gone through the roof. You did speak about aviation, but just want to delve into this entire, hotel space as well. Where is it that you're sensing opportunity from the listed players?
See, there is, unfortunately, there is only one and a half listed player, if you ask me. The one listed player who is decently making money, which is, of course, we have a holding, so for disclosure, Indian Hotel. When I said half means, I never understood that why Oberoi Hotel, which is the most premium hotel, never made money all these years and still hardly growing. So, it's barely an investing proposition at this point of time. So India, unfortunately, doesn't give you any option apart from this and Lemon Tree. Where do you invest? Both are today, have covered up a lot of value. I'm sure there is a lot of value. The only risk we see is that you need to take money off the table in the next 12 to 18 months because they are following the same strategy what the multiplex followed. Fleece the investor. Now, fleece the investor can go on for some time. It cannot go on for all the time. And when the demand dips, it will dip and it will dip such drastically they will not know where to go. So I still say if there is reasonableness in part of the hotel companies, price it reasonable, make a product reasonable, I think it's still a good buy. It's a long-term buy. If they follow the multiplex strategy of fleece the customer, I think 1 year, you got to be out of these stocks because that's the longest runway they'll have for the next 6 to 9 months. Through this holiday season, through the marriage season, and then you are done with it at the end of the day. So I think you already got fair valuation in the stocks. If you want to invest now, you got to be very clear. It's not a 5-year story now. It's a 1-year story where you need to book off and get off the bike at the end of the day. Because this story is not going to end well, given the way the valuations are in terms of hotel room pricing, etc. You can do it up to a point. You can't do beyond that.
Okay, I'm curious, Ajay, to get in your take on this entire ONDC, foray into the food delivery space. It's a very mixed view. Some are saying yes, there's going to be massive competition, etc., for the food delivery platforms, and then the others are saying that you cannot have, as of now, an ONDC which is just about starting. If they cannot bear the delivery costs, etc., it is going to be a huge challenge for them to keep up with the likes of the other two players. Your take?
Of course, absolutely correct. You get used to it. You put an app on your phone, you get used to it, and you say, okay, people who do Zomato, people who do Swiggy, rarely do both at the same time. There's a lot of brand loyalty to that product that you get used to using an app, used to using a system, and the delivery. To get your delivery system going, they have taken years and hundreds of crores of rupees. You can't duplicate it. So I totally agree with that the strategy of ONDC to get into this delivery business is stupid. They should not do it. It is not required by the country. There are lots of other things they're doing correctly. They should focus on them. For this, they don't have the dollars to spend to compete with these two majors. And they will improve. It's not that existing guys are going to just sit quiet. They're going to also improvise, improve, and more importantly, they come up with lots of marketing schemes. You've got a lot of marketing talent. You've got innovation. You've got advertising. It's just not about physical infrastructure. And I think it'll be a doom for it. There is no threat of any kind in my belief with this. Now, whether these delivery companies reinvent the model for profitability is a different issue. But I don't think so. Entry of a third player on DC can do anything to these players. These are too well entrenched. Bottom line is, your phone can only take so many apps, and these two guys have got your phone space.
Would you buy Zomato then?
Sorry?
Would you buy, in the spirit that Zomato stock got whacked last week, ONDC, burgers are 30 rupees cheaper, would you buy that?
See, as I said, you have to put, Nikunj, I keep saying, a bucket of new age stock. You cannot just sit on a Zomato, you cannot sit on a Paytm, you cannot sit on one stock. You need to buy 4 or 5, just like any other PE fund, and hope some of them perform. They are good business models. It's not the business model is not good. They just need to find a way to profitability, and they will get value. The problem with the stocks is the moment the price goes up, all the old investors want to sell. And therefore, if you are a new investor, you must be cognizant of that at every price increase, you'll find existing investors selling. You've seen that's happening in Paytm. Performance has been superlative, but the old investors keep dumping stock in the market. So the point is, you got to be invested in it, but build a portfolio theory and have ammunition to keep buying on correction, because correction will come, supply will come. It will take about 2 to 3 years before supply stabilizes out of the system, and you can get good returns out of it. And that's where Nykaa scored a little bit. It's gone down drastically, but it's still scored. It doesn't have too many shareholding in the public. The moment they start to sell, you'll find what happens to the share price. It'll be massacred. So I'm saying build a portfolio, do not buy one stock, and keep ammunition to average down, because 2 to 3 years down the line, some of these stocks are going to give you very healthy returns in the market. And they are now not going to be replicated. India will not have news stories of Swiggy and Zomatos for the long time, or a Paytm or a thing. So piggyback, build portfolio, add it to them when correction, and hold it for a 3-year period. I think it will give you very handsome returns.
We've seen a lot of these, small pockets. Like yesterday, we saw electronic manufacturing as a theme which got picked up. Do you think electronic manufacturing could do what railways and defense have done in the last 2 years for investors?
I don't think so, because intrinsically, Nikunj, the margins are so small. They're slim, less than single-digit margins in this industry. Now, even at highest of scales, you barely make any money at the end of the day. And to my mind, anything that is linked to government incentive plans is a no-go, absolute no-go. You don't know when it's going to change. A new audit will come. The CAG will file a complaint. You saw what happened to the electric EV two-wheelers. I'm not saying whose case is correct, but I'm just saying, look at the uncertainty you are sitting with. When you start to invest based upon government subsidy schemes, I think your starting thesis is wrong. If you invest based upon that the customer needs a product and the company can make a good return out of it, I think that's where you put your money. It doesn't matter to me, 4, 5, 6%, EBITDA margin. There's no businesses. There are trading opportunities. And for us to make equity returns out of such companies, far more difficult, believe me, far more difficult. Why do it? This market universe is giving us so many better opportunities. So electronic trading assembly units, I think it's a no-go for us. And we have not missed anything out at the end of the day.
Okay, fair point. Appreciate your time. Thank you for joining us.
Thank you very much. You have a good time.
Thank you very much. Always a pleasure to have Ajay Srivastava on the show. Quess Corp. Let's change gears and talk numbers and the corporate performance, quarterly numbers for the quarter gone by. Guru Prasad Srinivasan, CEO of Quess Corp, joins us, and we've got Kamal Pal, CFO of Quess Corp. Gentlemen, good morning to both of you. Thank you for joining us. Now, for the quarter gone by, revenue is up 17%, but there seems to be a stress on profitability and margins, and EBITDA is down. Is this a cyclical downturn, do you think, which has hit Quess Corp for the quarter gone by, largely because of what is happening in the IT space? Guru, sorry, you are on mute, I think.
Hi, Nikunj.
Hi, good morning.
It's always a pleasure speaking to you. In a sequence for last 2 years, we have been able to add 70,000 plus headcount year on year, and that's a kind of milestone. And sequentially, we are able to deliver that. And our revenues have been up by 25% year on year, and our OCF has been upward of 70% operating EBITDA to OCF conversion in terms of 71% year on year. So PAT, when it specifically comes to Q4, we have an exceptional item which is largely related to a sale of an asset that we did in Q3, which is also kind of the taxation on that is impacting in Q4, but it's a one-time impact which is coming into. Otherwise, the way to look at overall, we have invested cautiously. We have invested into product-led business, which is almost about 100 crore of investment that we did throughout the year in FY23, specifically for Found It, which is our job portal business which we are into. That business is really turning around well, and that investment is also kind of responsible for reduction in PAT for FY23 and FY24. We would have lesser burn coming in because our revenues are turning around exceptionally well in our product-led business. So, it's an investment phase that we had to go through.
But Kamalpal, the slowdown in IT is real, and the slowdown in IT is something which is a universal fact. And the fact that Indian staffing / hiring firms, they get a lion's share of their profits from IT is not new. How realistic is the concern, and how much do you think this slowdown in the IT services sector could impact Quess Corp in this financial year?
So it is having some amount of impact on our results, as it would be evident from the results. The IT staffing sits in the workforce management platform for us, and the open positions are definitely down to what the normal levels it used to be. So this business has had an impact on our results. But what we have done in this time is we have actually tried to right size our cost. We have worked on our IDC cost, and I'm happy to state that we've been able to bring down our IDC cost from 5.7% to 5.4% to compensate for the margin reduction which is coming due to the slowdown in the IT hiring space.
So, Guru, what is the out of jail card then? The slowdown in IT is real. I'll go by the commentary of large cap IT companies. They are not even keeping up to their campus offers. I look at startup hiring, it is almost at a multi-year high. I look at Google / Alphabet, Amazon, even SaaS companies, all of them are saying that we need to cut costs to manage our profits. All of them are laying off. If the backdrop is not hiring, it is layoffs, how will you come out of this? What is the out of jail card? I'm using this monopoly term. Been playing monopoly with my son, so I'm using that out of jail card term.
Sure. Let me give you a little background on what are IT sectors that we work with. Our exposure to services, IT services business is about 35%. If I roll back to FY23 Q1 and Q4, the way hiring happened in IT services sector was phenomenal, and that also impacted us in H2 because obviously that demand tapered down. Having said that, we also have good exposure, and we work with product companies, engineering companies, and auto companies is where our demand coming from currently. And if I were to be a little more comparative there, earlier the tech talent was hired by largely IT services companies, but we are also getting a lot of demand from non-tech companies like banks, back office management, BPM management companies. So where we are doing substantial hiring like AI, ML, RPAs, and a large process on SAP in itself. So, that's part of the product for us. So our demand would not be as expected. It's right that IT services definitely continues to contribute. We are eagerly waiting for them to get back into hiring. But our demand is down by 60% in a normal comparable way. But however, in that 60%, we are ensuring our fulfillment gets better. So we are progressing from a low margin to a high niche kind of fulfillment that we are currently doing and sustaining this phase. That's what is keeping our overall, bottom line healthy at the moment.
And to add to what Guru said, IT staffing India, contributes 7% of our overall workforce management revenue. So that way, we are to that extent, rightly deleveraged because we have huge exposures to BFSI, which contributes such a 31% to the general staffing revenue, retail, which does 22%, telecom and industrial sector. So while there is, like Guru said, there is a bit of a slowdown in IT, but then there are other sectors who are doing well for us.
Discuss the other sectors. What is the outlook, Mr. Srinivasan, when it comes to growth in the integrated facility management and security services business?
Sure. So, there has been some good green shoots this year. So we have been able to clock almost about 24% of our revenue growth in OEM sector, which is our integrated asset maintenance. Followed by the food business alone has grown and recouped back to about 72% growth in a year, which means we had almost gone down and to extent, it is really picking up well. Little cyclic and seasonal business. But delivered extremely well for us in last financial year. Followed by security business has grown about 19% by revenue year on year. So we are definitely, it's not a great shout at the moment, but we are seeing green shoots coming up in that space.
There were also projections that you're aiming for a 20% EBITDA CAGR through enhanced sales capabilities, your technology, etc., and that'll help grow your EBITDA. Can you just walk us through what the outlook is in terms of your growth projections, Mr. Srinivasan?
Sure. So, see, even if you look at in the current, FY23, we have been able to deliver upward of about 20%. We are at a group level, consolidated, we have delivered 25% of our revenue. And I still see a kind of, if I look at order book and the kind of ACVs that we are at pipeline, we are still confident to continue to, grow at a 20% year on year. That is something quite promising for the way outlook we are seeing.
Confident that this 25% growth rate will continue. Sorry, I missed that.
I said we have delivered at 25%, even in this tough condition. Considering the kind of order book and pipeline that we have, we are still confident to grow 20% year on year.
It's going to be organic, right? I'm assuming there is no inorganic element in it.
That's right, absolutely.
Okay. Kamalpal, FY20, now IT is a cyclical business is what we've understood. We may call it as a linear need, but the business trends are cyclical. What happens if the demand starts coming back in the second half of this year or first half of next year? When will it start coming back in your balance sheet? Do you think a business like Quess Corp would be a beneficiary of early demand? Will it be a lead beneficiary or will it be a lag beneficiary in this case?
So we will be definitely a lead beneficiary because I think the kind of recruitment capabilities and the recruitment engine that we have built Like Guru said, we've done a 70,000 plus net ads year on year, which is, a very big number, but we have now delivered it, 2 years in a row. So we are confident in terms of our capabilities of hiring, and hence we definitely, and we are, in terms of staffing the leading in the country. So no doubt about this, that, we will be the lead beneficiaries as and when, this demand comes back.
Gentlemen, appreciate your time. Thanks very much for joining in, giving us the outlook on individual segments and growth projections and what the outlook is for Quess Corp. That stock currently under pressure, down about 5% at 376. Very short break, but we've got lots more corporate voices and market men joining in. Stay tuned.
Well, SBI is all set to report its Q4 numbers today. Let me take it across to Harsh, find out what his poll is pricing in.
Well, yes, we're expecting a solid expansion with regard to net interest income, 40,000 crore. That's a significant 28% expansion on a year-on-year basis. We're also expecting operating profit to go up along the lines of that. So 27%, increase in operating profit coming in at roughly 25,000 crore odd. So we're seeing those two numbers showing a healthy uptick. Provisions, on the other hand, is going to show a downtick, which is a positive. So all of that aiding profitability. But let me first take it to provisions. Provisions were at 5761 crore in Q3 of FY23. In Q4, we're expecting that number around 5500 crore. So we're seeing a sequential downtick there, which will aid profitability. Profits will go up 65% is largely the consensus. 65% higher on a year-on-year basis. 15,000 crore is where that number is expected to be at. In terms of the balance sheet itself, advance is expected to grow a solid 16% year-on-year, but deposits are expected to show very, very tepid growth, 2% sequentially, 6% year-on-year. But keep an eye out on that deposit number, because going forward, what's the commentary which SBI gives out in terms of that deposit growth number is going to be key. The other piece that's going to hold the key is, of course, NIMs and credit costs. Credit costs are expected to trend lower, but at the moment, it's a benign credit cost environment. Going forward, what is the guidance is going to be the key as well as on the MSME front, how is asset quality is going to be looked at. So largely a solid set expected from SBI, at least this time around. Commentary forward is awaited.
Okay, thanks very much. We'll be keeping an eye out on that stock ahead of earnings. 588, very quiet in trade. Let's connect with Anuj Kathuria, who's the president JK Tyres, to discuss their quarterly performance. And thank you so much for taking time out. There has been a margin expansion due to the raw material cost benefit, but at the same time, there are players in your industry that are indicating that the benefit could be rolled back in Q1 FY24. What's your outlook?
Yeah, so when we are talking about Q4 in specific, we on a consolidated basis, we had a overall revenue of 3,645 crores, which is an increase of 10% over the corresponding quarter. And the margins also had increased by almost 360 basis points. So this has been a good quarter for us. And this has been possible, both backed up by the overall better realization. The net sales realization was better. And also the raw material prices had seen a kind of a softening. We expect that going forward, the raw material prices should remain stable. We have seen a lot of volatility in the last 2 years, but then in the last 2 quarters, especially Q3 and Q4 of last year, the raw material prices were quite stable. And we expect that the trend should continue going forward. On the NSR side, yes, there can be a little bit of pressure, but as of now, when the demand is holding up, the demand being buoyant, I think so the pricing also will hold true.
Sure. So you're saying that demand is resilient and raw material costs are expected to be stable. Then how much more headroom for margins do you see from here on?
See, for the year as a whole, our margins were at around 9%, 9.1% to be specific. So there is Q4 was definitely better. But we have, throughout the year, when we go from one quarter to the other, there is an element of seasonality. So quarter-wise, the demand plays out slightly differently, but we expect that going forward, with a steady demand being there, and if the raw material prices were to be also holding to the levels that they have come to, I think, yes, the margins should be getting better. But by how much and to what level is something that we will have to wait and watch.
Now, your Mexico business has done well, and when we compare the kind of growth that we've seen in percentage terms, and an outperformance has been seen in the India business, what is the replacement demand growth outlook for your international markets?
See, on the export market, the exports that we do out of India, quarter 4 was a little subdued. We have seen that there are certain headwinds in the global economic scenario. We expect that this should start easing out in this financial year. Maybe not in quarter 1 completely, but from quarter 2, or definitely from the second half of the financial year, we should see the normalization in the demand in the export markets. When we talk about export markets, the ones that we are getting to are the markets in North America, including US, Mexico. We also have reasonable exports into markets of LATAM, Middle East. We are working on certain markets in Africa. So overall, we see that these markets, the demand should be coming back, especially the emerging economies. We expect that the GDP growth should be upwards of 4%. So overall, I think so there should be a recovery into the exports market.
Right. So update us on your capex plans as well. In FY24, what all capacities are expected to come on board?
So, as we had already shared with all of the people, one of the expansion programs is in the area of the passenger car radial, which is having an outlay of close to 530 crores. This would be adding a capacity of 1.6 million units. That is also being kind of pursued actively, and it should be start giving the output. There will be a ramp up, but we should expect that it should start playing out in the second half of the current financial year. The other program that has also been announced is in the truck and bus radial. That has an outlay of around 260 crores. So both put together is close to 800 crores. So this would also help increase our overall capacity in the truck and bus radial by around 10%. So this again should start ramping up from the start of the second half of the financial year, and should go into full output by the end of the financial year.
Now, historically, capacity utilization for the Cavendish subsidiary has been lower than that of JK Tyre on a consolidated basis. Is it at par now?
Yeah, in fact, for the Cavendish Industries, which is a subsidiary, the quarter 4 has been quite a good quarter. In fact, there the capacity utilizations have been better, especially in the truck and bus radial and also in the 2-3-wheeler. As you know that the 2-3-wheeler tires are manufactured only in the Cavendish Industries. So there again, we were at a very high level of capacity utilization. This was an outcome based on the demand coming in from the replacement market and also from the OEMs, where we have secured further business, and we hope that this level of capacity utilization will continue. As far as the TBR segment is concerned, we were in excess of 95% capacity utilization in Cavendish, and this plant mainly caters to the replacement market. So there again, the overall demand is quite robust, and we expect that this demand will continue. In fact, the expansion of capacity that I spoke about in the TBR segment is being pursued at the Cavendish plant itself.
So could you update us on your current debt levels you're holding on your books, and what are the plans then to repay that? And what exactly is the target for repayment as well for the fiscal?
So if you see that at the beginning of the last financial year, we were close to a debt of 4,900 crores, which has been now reduced to a level of 4,500 crores. And going forward, we expect that we will be able to take off another a similar amount in the current financial year. And thereby we will be able to come to a level of somewhere in the range of the 4,000 crores.
All right, good to have you on board. Thank you so much for taking time out and joining in. That's the view from the management of JK Tyres. Raw material prices will remain stable, and they are saying that it's tough to guide on margins as of now due to the raw material price volatility. And that's the stock price of JK Tyres, currently down in trade at about 190. But the rest of the market then, and Nikunj, we've been talking about this, no surprises then to see this sort of a move. But the fact that for the last 2 straight days, it's been the small cap index that's taken somewhat leadership compared to the
It'll go on more, Avan. I mean, I just look at the screen. Just give me a minute. I'm just going to log on to the Bloomberg screen. I think somebody...
Yeah, we're up 0.6% for the mid and for the small cap index, and for now for the frontliner, 18,236.
No, Avan, the point I'm trying to make here is that, look, overbought market, oversold market neutralized. It started with large cap stocks. Then the leadership came in the bank nifty. That is a well-established fact now. Typically, small and mid-cap stocks, which have very little relevance in terms of earnings, and when they start doing cartwheels and when they start, getting a lot of volume attraction, it is the Johnny-come-lately or the FOMO crowd which is kicking in. So the top-traded counter on the Bombay Stock Exchange and National Stock Exchange right now is Brightcom Group. We know that there are challenges there in that company. Yet the stock is the top-traded stock. Then there is Suzlon. Then there is BLS International, Vodafone Idea. Some railway stocks are there. So this is the first sign that the Johnny-come-lately or the desperate left-out crowd is now coming back in. I think this is just the beginning of the first point where the markets now will soon move into a zone of comfortable to uncomfortable zone. Participation has started. Markets will never peak out when on the day one of participation. It will be few days of participation before it will peak out. Okay, so Inder Singh Gill joins us now, CEO with Hero Electric India, and let's understand from him what the Economic Times today is reporting, that the subsidy on the electric two-wheeler should be slashed. Now, Mr. Gill, good morning. Thank you for joining us. I'm going by what the Economic Times today is reporting, which is that the subsidy which is currently coming through a scheme to two-wheelers should be slashed, as the EV two-wheeler space now is big enough and they do not need any clutches or hand-holding.
Thank you. Well, early warning signs were already given by MHI around 4 months back, saying that their target of 1 million in 4 years has been achieved or going to be achieved, and their budget will be exhausted. So sort of a commitment of continuation was not there. But was it to happen this way? It was slightly a surprising thing, because nobody believed that suddenly carpet will be pulled out of the feet of OEMs. And increase of 30 to 40,000, something like 25,000 to 40,000 is on the anvil if they pass on, which will become difficult for many of the OEMs to sort of sell those volumes. So there's, I think, I'm very sure the market will go down drastically due to this step, and may take a lot of time to cover up.
What is the plan B then? I mean, do you hold back and not pass on through this cost increase on to consumers to try and protect your volumes? What's the solution?
No, as an industry I'm talking, it's very difficult for people to hold on. There are two sets of OEMs here. For the last 5-6 months, everybody's subsidy was stopped. But lately, 4 of the OEMs, like Ola, Ather, TVS, and Hero Moto, they got out of it and they are getting the complete subsidy back. And they are selling the bikes with huge subsidy, like 50,000, 60,000. And the rest of the people, they are not yet out of the woods, so their subsidy has still been stopped and may not be even available by the time the budget is over. So the industry skew has happened. The premium bikes have been sold in huge quantities, and the startups and the city speed bikes, affordable bikes, have not at all done well because of the skew of subsidy not being available for those guys. That's one thing that happened. But the other side is that the same 4 premium bikes will now suffer the highest, loss in terms of subsidy, and suddenly the prices will be felt highest by the customer. So it's likely that the premium segment will face the brunt, and I'm not very sure if they have so much deep enough pocket to sustain through 50 to 60,000 loss, or maybe 40,000 loss for a long period of time, because they have just come out of that another refunding that they have to do to the customer of 140, 130 crores because the charges were sort of misrepresented and under-invoiced. So it can't be a long game. For some time you can do for market access, but no, not forever. Customer, I don't think so, is going to be attracted to buy a bike if it is going to cost after subsidy 1.5 lakhs or 1.6 lakhs.
What happens to the incumbents who have deep pockets?
The incumbents means, like by name you're saying who?
Two-wheeler space, Hero Electric, in a sense, has got deep pockets. Ola has deep pockets.
No, first is Hero doesn't have a deep pocket. We are nothing. We are nowhere near Hero Motor.
Come on, sir, you're being modest now. You're part of Hero Group.
Yeah, no, we are not Hero Group. We severed from them. We are their competitors now, in fact. But we have suffered the maximum because our subsidy of 600 crore is stuck and there is no visibility of subsidy going ahead. In any case, our market shares, you would have seen, have dropped to near zero, and we are not reducing anything. So we are the worst sufferers there, but we are somehow going through this, and we have made our business plans accordingly to conserve capital and go slow on this. But all the startups, all the MSMEs, similarly have suffered heavily in the last 4 or 5 months on the volumes. And the clear divide is seen if you see Vahan records, how the premium bikes have taken away major part of subsidy in the last 4 or 5 months, and the others have suffered because their cases are still under investigation.
So what you're telling us, Mr. Gill, is very different from what the market perception is. Market perception is that in India, the EV launch, whether it is cars or two-wheelers, it's been a great start. What you're telling us that the ground reality for EV two-wheelers is very, very different. It is still a business where you need to subsidize it, and off late, because there is, if subsidies change, the drop could be more.
My reasoning is because of, cars cannot be treated as two-wheelers. Two-wheeler is like a commuter bike, like a normal large population of India which can't afford higher price. They go for two-wheelers, others go for small cars. So it's a very price-sensitive market. And second is, still today, the total cost of ownership has not really got established into the minds of the consumer. They are first going with the sticker price. And sticker price, if they find very much way off from the petrol bikes or petrol scooters, then they don't buy, unless it is hugely subsidized by the government saying, okay, this bike is worth 2 lakh, but you're getting for 1.4 lakhs or something. So that is the difference, that this segment itself is so price sensitive. For decades, we have been selling petrol bikes at 60,000, 70,000, now 80,000. So all that you can think of is selling at 120,000, 130,000, and then get the other advantages of running costs, etc. Because you not even comparing like-to-like bikes. These bikes have the deficiencies of charging infrastructure and so many other things. So from that point of view, we had been saying always in industry that, okay, the subsidy cannot go forever, surely, because you can't tax the common man as an exchequer, but you can't suddenly switch off and switch on also. Let's reach a level. Today, we are at 4.9% of the total two-wheeler market as electric. It's a nurturing stage, too small a stage. We need to reach, internationally, there are signs of reaching a stage of 20% or so in any vehicle to make it self-starter growth. We are far away from the 20% conversion from two-wheelers to electric two-wheelers. It will come, I think, in 3 to 4 years if subsidy continues. So I was hoping that another set of subsidy continues and then gets tapered off so that it becomes, whatever has happened till now, then takes off as a big launch and we don't have to look back. So this is retrograde step, which will surely we'll have to look back, rejig, go back to a base level, start selling half of or less than half of what we were selling, hope the market recovers out of it, hope the customer accepts the prices, which is a big, big hope, but no confidence.
Okay. All right, Mr. Gill, appreciate your time. So glad you could join us.
Thank you.
Here's an excerpt of Now's interaction with the management of Vari, and we also had Ravi's company. ValueQuest is a investee company in Vari. That's public information. Now the idea here is to perhaps interact with fund managers on the site with the management and try and understand the rationale that why as a firm ValueQuest is bullish on the Indian manufacturing sector and why Vari in particular. So here's an excerpt of ETNO's site visit along with the marquee fund manager, understanding the rationale and the future path for the Indian solar manufacturing sector.
We've been discussing the entire Indian manufacturing sector and how the manufacturing sector in India is at a J curve, whether it is ability, capability, or change in the global order. And Ravi has been talking about it on our various interactions that at ValueQuest they've taken a huge, a mega bet this time in the manufacturing sector. So one of his portfolio companies is actually Vari Energy. And Ravi, it's the first time we are talking to you outside the studio at a real location to understand the thinking. Now, this is the manufacturing of a simple solar panel cell. But this is the future of India in terms of manufacturing, what India is capable of. So how are things tying up for you? Whatever we've discussed on paper, is the reality now really applicable?
So, you know what, Nikunj, we have spoken a lot about the mega trends that we are bullish on, and manufacturing is definitely one of them. But this particular company, Vari Energy, is actually being powered by two different mega trends. One is the manufacturing in India, and another is the energy transition that the whole world is going through. So, if you have two boosters, that's fantastic. So, for example, chemicals also is a beneficiary of manufacturing coming to India. But that is a mere supply chain shift that is happening. While what is happening in solar is it's not only a solar supply chain shift happening, but it is also that India is a growing energy market, world is a growing energy market, and it is moving away from fossil fuel towards renewables. Now this company, I'm sure you have spoken with Hiteshji and you realized solar is only a starting step. This company is going to play the entire spectrum of the energy transition. So it starts with whenever you invest in a manufacturing company, you want to have the benefit of capacity utilizations going up ahead, operating leverage kicking in, expansions happening. Everything is happening in hyper mode in this company. The company is changing scale dramatically. This company did a profit of 70 crore in FY22, is going to do, okay, these are unaudited numbers, but it's probably going to do closer to 500 crores profit in FY23. And this kind of a hockey curve is going to continue for another at least 3-4 years. So obviously that is the confluence of the two mega trends that we are talking about over here.
But Ravi, energy transition by nature is a business which requires technology adaptation. It requires a lot of capex, and it's a place where the big boys have dominated the space. And now the big boys are there. Reliance, Jindal, even for that matter Adani. Where does Vari fit in the picture?
So I'll tell you, this is an ocean, okay? And in ocean, there can be more than one large blue whale. In China also, for example, which is the largest whale in this ocean, also has 5, 6, 10 different companies that have reached a size of 80 to 100 gigawatts. This company that we are talking about is a leader, but it is still at a 10 gigawatt kind of a size. Over the next 5-7 years, the size of these companies is going to grow multifold. So I don't think the conglomerates coming in is going to reduce the pie. In fact, the pie is so big that they will also add to the demand rather than add to the supply.
Yeah, actually I have Hiteshji also with us. So Hiteshji, thank you for having us over, Ravi, and I can speak on behalf of Ravi that we both are delighted to be here.
Thank you very much for coming all the way, both of you. I really appreciate that.
It's our pleasure.
So Ravi, what prompted you to invest in Vari? You set the big picture, but a financial investor will look at top down, the big picture, and bottoms up, which is the valuation and the uniqueness about the company.
So it is not only about valuation. So there are three things to an investment opportunity. One is that opportunity should be good. Two, you have to find an entrepreneur and a company that is doing the best job of riding that trend. And then of course comes the valuation. But when such a large opportunity is unfolding, and when you find a company that is a leader, you don't have to think twice. You know, the valuations eventually will unfold. The opportunity itself is so large that, you know, we'll be laughing at ourselves 5 years down the line that how did this company was available at this kind of valuation.
Why was it available? Why did you sell cheap to him?
I'm sorry?
Why was it available cheap and why have you sold him cheap?
Because we are the enablers of the opportunity. An entrepreneur needs capital. They have a huge growth capex planned, and for that they need money. So it is not that they sold out cheap, but we are enablers of them being able to tap that opportunity.
So you are hand-holding the Wari group to really understand that how wealth can be created for shareholders. I respect that. But I'm sure with what to do, there is a long list of what not to do. So what is that what not to do list?
So obviously we have the advantage of having the vantage point of looking at many different industries and what are the mistakes they made. And usually it is debt related. Most of the time, how to manage debt. I don't have to teach Hitesh Bhai anything. Hitesh Bhai is far more prudent than I am. He has managed to keep the company debt free, even despite the fact that he was competing with the Chinese for the last 10 years. So he is a frugal manager by nature, and he manages the debt as well as the return ratio. So I am happy to be here if there is any advice is needed. But fortunately for me, he doesn't need my advice.
We'll need a lot of advices, and we want you to continue your help and guidance in this journey.
But it is eventually, it comes down to this whole part that every technology has a life cycle. Steam engine had a life cycle. I'm sure the technology, what is at play here, both solar and non-solar, will have a life cycle. You will get few things right, you will get few things wrong.
Right.
How would you adapt to this ever-changing need of technology?
When you are in a technology business, you are sure that the technology shelf life, particularly in the solar, is not more than 2 to 3 years. So last 15 years, I have seen the 5 cycles. We started with a module of a 10-20 watt. Today we are at 550 and 650. So this journey will continue. Machines need to be changed. Training needs to be upgraded time to time. And that's a part of this journey. So it's not something special or new when you are in technology business.
Ravi, historically you've invested in businesses which don't need too much of capital to grow. If I look at pharma, your technology investments, because ultimately if the need of capital is, the return ratios will remain compromised. What I understand from him is that this sector will keep on needing constant capital, which is always a no for an investor.
No, so I think last 10 years was a time period in India when you should have avoided businesses that need too much of capital or too much of debt. Now the next 10 years, you are going to make a lot of money investing your capital in businesses that need capital. The metric to focus on is the incremental ROCE from that business. Is it attractive enough or no? And even if it requires capital, the reinvestment rate and the returns earned on that is making the company even more attractive, in my opinion. Which company in manufacturing sector do you know that can go from being a 70-80 crore profit company to a 2,000-3,000 crore profit company in a span of 5 years? That is the kind of scale up that we are witnessing. That is possible only with capital, right?
It is why the other point is that once a company reaches a curve, there is a different talent requirement, there is a different HR requirement, there is a different type of challenge to manage scale. Right. The only sector which I think has done very well in India, I think, is IT. They started small and they built up scale. Right. How will you manage scale? Because the numbers what Ravi is talking about, the numbers what he demonstrated, it is humongous. Whether it is blue sky or deep ocean, whatever may be the terminology, the size is huge.
Definitely we need to change the way we are doing the business. We need a lot of intervention of the various consultants. We need that kind of the talent. So execution is the key now. An entire organization working in that direction to get the talent, to change the processes, system, corporate governance, and for that very reputed consultants from India Germany and China are already on the board, and they are helping us to scale up this and change the way we are doing the business.
So, Nikunj, I'll add to that. Hitesh Bhai is being a little modest, but and scaling up is not only about the numbers growing. It is also about going from being a family organization to a professional organization. So they would have recruited more than 40 people in the senior management roles. They have gotten E&Y as an auditor. They have KPMG as an internal auditor. Their independent, the board size is growing. The reputation of the board is good, and the kind of systems and processes that they are putting in place, it tells you that this is not a small company anymore. It is a company that is probably do $1 billion profit one day.
Do you see $1 billion?
One day.
I wanted to qualify that. You know, when it comes to $1 billion, suddenly I get my antennas up. Ye kya hai? I mean, if you think about it, Ravi, I don't think beyond 30 companies in India, they clock $1 billion of profit as of today.
I'm also counting on rupee coming to 40.
So do you see this investment of yours could be a multi-year investment? It's a multi-year opportunity?
See, any industry usually has a 3, 5, 7-year cycle. After that, it is really how versatile the management is in finding that new trend and riding that new wave. And that is exactly where I feel Hitesh ji has caught on to the solar wave. The solar wave will last at least 10 years, but he's already seeding for the next wave, whether it is batteries, whether it is hydrogen, electrolyzers. He's already seeding those avenues, which will be the next wave, maybe 3, 4, 5 years down the line.
What to your mind could be a deserving P multiple for a business like this? Are there any global references?
Let market find its own correct multiple. I am nobody to say this should be the multiple. What I know is that the profits are going to grow in a big way, and it will be rare to find a company that will be such fantastic size of profit, return ratios, and such fast growth. So that combination is very rare.
Our common friend, not our friend, but one of the common gurus we looked at is Rakesh Jhunjhunwala. He would always say that I will sell a stock when the P multiple is out of whack or there is a challenge to my core conviction. So when will you sell Wari?
I have no idea, but I can tell you it's not on the horizon anytime soon.
Why is that?
Because the opportunity is just beginning.
So it's not a trade. It is not an
Absolutely
opportunity.
not.
You are betting on a multi-year.
I am telling you, right now, next 3 years are only about solar. But beyond that, this company is going to morph itself into an fantastic energy transition play. And I think that is where one should be betting on.
One final question before we wrap here. And we're just enjoying the tour of this lovely facility. The energy space has one element, and that's an element which nobody knows, is the policy framework. It has changed. It will continue to change. Sometimes it could be rigid. Sometimes it could be stupid. How do you guard yourself in this dynamism where countries are trying to get the energy sufficiency right?
The first thing is that now Ukraine war or what are the energy prices have given a clear mandate that we need to go on the green energy. So what are the policies will come? Of course, there will be some hurdles all the time. But at the end of the day, everybody wants to go for the renewable energy. And for next 20-30 years, you talk about the Paris Pact or you talk about the Indian government 2030 target or 2050 by net zero target or ESG. So this way is decided now. And hurdles are going to be the part of the way. So personally, I don't see that the policies will stop this growth. It may be for a few months, like we are seeing at present in India. For the local manufacturers, there are some hurdles, but they are not going to stay for a long time.
So Ravi is assuming $1 billion profit with rupee at 40. But rupee stays at 80, when will you do $1 billion of profit?
I don't want to talk about the numbers again. I will say that help us to make sure that everybody's energy, not only the country becomes the energy independent. I will say everybody becomes the energy independent, number one. And number two is everybody has his own carbon credit account where he says, I am staying with the net zero. So net zero target should not be only for the company or country, it should become an individual also.
Can I give you an idea which will boost up your business in next 10 seconds?
That will be great help.
So ValueQuest does not have any Wari power solar units.
I'll make sure their walls of the buildings became the solar power.
See, a solution and something to look forward to. Really appreciate your time. That it's so fantastic to really understand your thinking behind investing in some of the portfolio companies. And, we must try and do this more often, trying to really understand the thought process of what you're following right now. That's it on this special show. I don't want to name the show anything. We just simply call it On Site with ET now.
Thank you very much. Thank you.
Thank you.
Thanks everyone. Thank you.
Thank you.
Thank you.